Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be talking about STEM because they are going to be announcing earnings this Thursday, May 2nd, after hours. All the information I'm going to cover today can be found here on the STEM Investor Relations website, and I'm going to be looking at the latest investor presentation. Now, this investor presentation is going to share a number of similarities to what was presented on the Q4 2023 earnings call where we last covered the stock. As you go through this information, I would note that it's going to be a lot of the recurring themes. This investor presentation did come out on March 19th, so it's not exactly brand new information, but we should be looking for a significant number of these guiding principles to be on display in the Q1 earnings. The first one is going to be that generate free cash flow. Now, it's important to note that for GAAP purposes, which is the accounting standard that these institutions are under, there is a difference between free cash flow and net income. So a company can still be cash flow positive, but net income negative. And that appears to be the expectation associated with STEM for 2024. What we're going to be looking for is, are they going to be able to continue this profitable, or rather the positive EBITDA that they saw in 2023, which means that we would expect to see continued positive cash flow. The associated build with this is, hey, if we can have stronger cash flow positive software and professional services revenue, then the expectation is that the company will be able to churn a higher profit, which will enable the company to grow in a profitable manner. Down below, one of the things I would note, this revenue number as well as the GAAP and non-GAAP gross margins are lower than they was originally forecasted. However, contracted annual recurring revenue did come in line with expectations. It's important to note that when we're talking about this recurring revenue on an annual basis, as well as some of the balance sheet items that we will see later, is that the company currently trades at a $300 million market capitalization, approximately. So one of the things that I would note is at the end of this year, the expectation is for that annual recurring revenue to be north of $100 million. So instead of valuing this as a up-and-coming AI growth play, I'm beginning to look at it as a value proposition via a value stock, which means steady growth, if it can be profitable, still showcases a lot of opportunity from an investment perspective, especially when the company is trading around 3 times recurring revenue, which is very attractive there, especially if they're able to turn that into a positive momentum. Now, the first quarter is always very, very low. That's just the timing of the year. And once again, we have very high expectations in the latter half of the year. What we're going to be focusing on is, can this first quarter beat expectations? Historically, the first quarter of the year has been around 15% of total revenue. It doesn't appear that they're expecting that at this point in time. Admittedly, I wouldn't be surprised if we came in with a strong beat. But what we're really going to be focusing on is this adjusted EBITDA number. Where is this first number going to be positive? Now, because they don't focus on net income, I'm not going to focus on net income. But in reality, that's what a lot of these companies are going to be valued as. But there is still a lot of this growth story associated with them. And as long as the cash flow is positive, I think that there's still a lot of opportunity in terms of the company surviving and not having to undergo any dilutive services associated with the stock. There is a lot in this that points to the growth potential, but right now I'm just going to focus on the financials, which is essentially going to be noting that revenue does continue to increase, albeit slowly. Margins are increasing as there is some of that larger software revenue does come online, and not just software, but also the service revenue. And we do want to see positive cash flow coming into this calendar year. From a continued performance perspective, that CAR number is going to need to continue to increase. I still think this is a made-up number, but the annual recurring revenue is something that's still important. And they do have a hefty backlog, but the issue that I've come to have with this backlog number is that this can be delivered over any number of years. And if you think about some of these 5, 10, 20-year deals, some of that backlog is going to be baked in there, and they can't recognize that revenue until they deliver on the services. So this larger backlog is impressive, and I'm glad that we're seeing that get built in because it points to the future for this company. However, it still has a lot of concerns for me in terms of what they're churning from this backlog into same year or even next year revenue. So while I'm glad that there's positive momentum in these charts, as always, as an investor, I'd like to see more. That being said, on a fiscal year basis, last year revenue did grow 27%. We were expecting it to be significantly higher, north of 50%. If we can continue to see 30% growth, as is projected in the forward-looking forecast above, I still think it's impressive if they can be north of $600-700 million. That's still north of a 40 to 50% growth rate. And we do want to see the expectations associated with those gross margins continue to go up. And what would be delightful would be to see some net margins. I don't see that for this calendar year, but it would be nice if maybe in Q4. So that 2024 guidance is out. We talked about it. Continue to be very positive associated with that, or there's a lot of positive momentum. The question is going to be, can they land some of those big deals they talked about on the earnings call? And do we have the expectation that they will actually hit their targets that they're telling us? So I do have some concerns associated with that. There is this focus on transitioning from the approach that they've historically leveraged to make sure that they have the capability to have larger amounts of car. Again, this would be a $30 million increase over year-end 2023. The question is whether or not that's going to actually happen. So there's a lot in this that I'm not going to necessarily review. Again, I think that there's a lot of positivity associated with it. I'll leave us on this key takeaway. And I would note that while the stock is down more than 50% on a year-to-year or year-to-date basis, there is some internal momentum in terms of a lot of internal buyers at this point in time are making moves in the stock, which could be a positive going into the earnings cycle and going into the rest of this year. The nice thing on some of these lower dollar stocks is it doesn't take much to get some pretty material returns. The downside is whether or not it's going to be a company in the immediate future. At this point in time, they haven't said that they would need to raise outside equity. They have strong cash positions, and my expectation is the company will continue to perform. The question is, are you going to see a double from here within the next 12 months? Or are you going to see continued downward pressure, especially if we continue to maintain a high rate environment? So there are a lot of moving parts, and this is some things that we're going to continue to watch as we evaluate the stock. It's important to note that for this earnings call, I will not be covering it live on the channel. I have some other obligations that I'll be attending at that point in time, but we will still be doing a review after I listen to the earnings call. If you found this content helpful, please leave a like and subscribe. Thanks. Talk to you later.